Hey, Eric here from 5minuteinvesting.com. And today we're going to talk about dividend stocks. What is it? How to think about it? What should you do when you're investing in it? How does it compare versus capital gain? I'm going to explain what that is as well. So the topic for today is going to be focusing on dividend stocks. So first, let's talk about what is it. So when you're investing in a dividend stock, you're really expecting a regular payment from a company as part of its profits. Now, sometimes it might be quarterly, it might be semi-annual, it might be annual, so that means once a year, and it can range from just a fixed payment of, let's say, $1 a share versus like a percentage. So if a stock is $10 and it's 2%, then it will be 20 cents. So the good thing is that you're really getting cash from stock, which if you are holding a stock for a long period of time, then dividend might be actually attractive to some investors. Now, I'm going to analyze dividend stock from the point of view where you want to make 30% and whether dividend is actually a consideration or whether it is important. Now, we covered what it is and how often. So let's talk about the range. So dividend stock, the range really varies, but if you're targeting medium to blue chip companies, then generally, as of we are recording this video right now, is around 1 to 3% is what I see the most often in terms of getting dividend. And there are some higher dividend stocks that offer a higher percentage, and we'll talk about that in a bit and how you can find them as well. So 1 to 3% is what I usually expect. Now, when you're looking at dividend, you're really expecting a regular payment from the company. Now, the key consideration when I'm investing in dividend stock is that I want the dividend to be low. And it is a little bit counterintuitive because when you think about it, would you rather invest in a stock that the stock price is going down, but then the dividend is really high? Or would you rather invest in a stock that the price is going up and the dividend is really low? And this is a key distinction, and that is actually a very important factor when you're considering dividend stocks. So if you think about the range, dividend is really 1 to 3%. And you want to compare that with the volatility of the stock. So how often does the stock move? How much does the stock move up and down by in terms of price? If you think like the stock can easily move 1 to 3% within a week, then that's your dividend payment right there. And dividend becomes less significant when you think that the stock is moving a lot. And this is especially true when you're looking at growth stocks. So if the stock is growing, if the price is increasing, you want to be focused on getting the stock right. You want to focus on getting the stock right instead of trying to find a high yield dividend stock, because the capital gain you get from it will be a lot higher than the dividend itself. And I'll dive a little bit deeper into this concept in a bit. So let's talk about how to find the best dividend stocks. Now, there are really two parts to this question, how to find the best dividend stocks. So the first way is pretty simple, and you just use a stock screener. Now, if you don't know what a stock screener is, it's just a giant filter for the stock markets based on certain criteria. So if you have never used a stock screener, I would recommend finviz.com, which is spelled as FINVIZ.com. And if you go there, you click on screener, then you can actually select dividend yield. And there are mainly 3 categories, which is none, the 4 categories: none, low, medium, and high. And high means greater than 10%. So once you found dividend stock that matches your criteria, maybe is greater than 10%, then you want to do your fundamental analysis on the stock to make sure that it is good. You want to look at the price, you want to look at the chart to make sure that the stock is good, not just investing in it based on dividend alone. So let me give you an example. So for example, HSBC. It's a very large bank around the world, and it's famous for being a dividend stock. Actually, a lot of banks are famous for being a dividend stock. Now, what's interesting about HSBC is that it is in a mature market, and HSBC is not exactly growing. It might be growing, but it's not significant. If you look at the stock price as of the moment I'm recording this video for you, you'll actually find that the stock price for the last 3 to 5 years has been decreasing, and it pays a good dividend. And would you rather invest in that's why I'm asking you, would you rather invest in a stock where the trend is down and it gives you a good dividend? And for me, the answer is no, because the dividend might be 3%, it might be 5%, but if you're looking at, let's say, 1 month of fluctuation within HSBC, that's like at least 5%. It might go up and down and so on. So if you are able to select great companies that has a good trend and select great companies with good trend and you can get in at a discount, you don't need to worry too much about dividend. So this is almost like a counter dividend video that I'm making for you. So when it comes down to the choice between dividend versus capital gain, for me, I would choose capital gain every single time. Now, why is that? Because right now I'm trying to grow my portfolio. I'm still in the growth phase of the portfolio. So I'm not trying to aim for something that I can get on a monthly or even a quarterly basis because I don't need the money right now. So I'm focused on reinvesting. I'm focused on growing the account so then it's big enough and eventually it will completely replace my income. So that's really what I'm going for. So unless you are in the retirement phase, you don't need to worry too much about dividend stocks. Now, how does dividend impact options? And this is very important because when you're investing in the market using stock options like I do, and I aim for 30% a year, you don't get dividend because you're using options. And when you have a stock that is, let's say, going up $10 to $11, and then it pays out $1 of dividend, the stock price will go down by $1 and it becomes $10 again. So in terms of option, that actually hurts your option because you don't get the dividend and the price still decreased. So you want to take that into consideration. A high dividend stock is actually bad to use leverage on in terms of using stock options for leverage. Now, what's interesting is, as a financial advisor, I've seen a lot of different transactions made by some of the world's largest private equity funds. And what they do is, if you can find a stock with a regular dividend on it, they'll actually use a bank loan to buy the stock in the open market. And as long as the interest rate for the bank loan is less than the dividend, then they think they can pull it off. Now, to me, I think that's a relatively risky strategy because the company can also always say, I'm not going to give you dividend this year. So then, someone needs to pay the interest regardless. So that creates a risk using that private equity fund strategy. So that's why I always use stock options and I don't use a bank loan when I'm investing because for stock options, it's just structured differently in terms of the interest payment. Now, finally, dividend as a signal. Now, when a company pays dividend and it pays more dividend, is it good or bad? And I think it's very important for you to think about it. Is it good or bad? Because, getting a dividend as an investor is fantastic. It makes you feel good. You're getting money from the stock. It's like you're reaping the rewards from your stock. But if you think a little bit deeper, why is the company giving you money? And why is the company on the market to start with? If the company is, on the stock market is trying to raise capital, right? If the company is trying to grow, wouldn't it use its profits to reinvest into its own business if that is the best? And this is the real reason why Apple hasn't paid dividend for so many years, because Apple has always been trying to grow, has always been trying to expand. And when Apple started to pay dividends because it was sitting on too much cash, is really because they can't think of another way to expand anymore. So, when they're paying dividends, it's really a way of telling you that, well, they're done expanding. Now, one of the interesting companies is actually ExxonMobil. It's actually an oil and gas company, and they pay a high dividend, which is great. And when you think about oil and gas, they are really mature. It's a very mature market compared to like Facebook or Uber or Airbnb or whatnot. And there's really no room to grow. So when they make money, the best thing they can do is to give the money back to you as an investor, so then you can do something about it because they don't have anywhere else to invest. And when you look at the price chart for ExxonMobil, is really not trending up. And the reason is because the company itself is not growing. So it's really just a cash cow. It's just generating cash. It's a mature market. It's just a matter of time before it starts decaying. So when you're investing in the stock, you might get a lot of dividends, but your price is not going up. Sometimes it might even be going down like HSBC as of the moment I'm recording this video. And you really want to focus on capital gain because at the end of the day, the dividend is just coming out of the stock price, which is just another way of saying is turning your capital gain into dividend for you for the next quarter or the next year. So if you know how to invest in the market, if you know when to exit, if you know how to read the charts and so on, then you can time to exit yourself. So you don't really need to invest in a dividend stock other than the fact it will make you feel better in the short run. But if you're looking in the long term, even when you get dividend, you actually want to reinvest it back into the market. You don't want to be spending it unless you really want the money immediately. So that's how I think about dividend stock as an investor who makes 30% or more in the market. And when you think about it, it really comes down to capital gain and whether the company is growing or not. So if you like this video, you can comment below or like the video and share it. And let me know if you have any other questions.